The trading floor was empty except for the hum of 3 monitors and the sound of a man's own breathing, ragged and shallow, like he had just run a race he never meant to enter. It was 3 in the morning in a city that never really sleeps, and on the screen in front of him, XAUUSD had just ripped through a level he swore an hour earlier it would never touch. He had been right about the direction. He had done the analysis. He had marked the structure, spotted the liquidity sweep, seen the setup form exactly the way it was supposed to. And yet his account balance was bleeding red, not because the market proved him wrong, but because somewhere between the entry and this moment, he had stopped trading his plan and started trading his fear. He closed the position 200 pips before it would have hit his original target, out of sheer panic, and watched frozen as the price walked calmly into the profit zone he had abandoned. He did not lose to the market that night. He lost to the flinch inside his own chest, the one that took over the second uncertainty walked into the room. And in that quiet, humiliating moment, staring at a chart that had done exactly what he predicted, he finally understood something that no strategy course had ever taught him. The market rarely destroys traders. Fear does. This is the truth that separates the trader who survives 20 years from the one who blows up in 20 days. It is not intelligence. It is not access to information. It is not even skill in the traditional sense. It is the ability to make a decision when the outcome is unknown, and to keep making that decision calmly again and again, without letting an ancient survival instinct hijack a modern financial decision. Because that is really what is happening every time a trader hesitates, exits too early, revenge trades, or freezes at the worst possible second. The brain does not know the difference between a lion in the grass and a red candle on a chart. It reacts to both with the same primal urgency, and unless a trader learns to recognize that urgency for what it is, he will spend his entire career being managed by fear instead of managing his own decisions. There are 4 fears that quietly run the show behind almost every losing trade you have ever made, and almost every winning trade you gave back. The fear of being wrong, the fear of losing money, the fear of missing out, and the fear of leaving money on the table. They rarely appear one at a time. They tag team. They disguise themselves as instinct, as caution, as excitement, as discipline. And until you can name them individually, you will keep mistaking their voice for your own judgment. Let's start with the fear of being wrong, because it is the quietest of the 4, and often the most destructive. Most traders think they are afraid of losing money. What they are actually afraid of is what losing money means about them. Being wrong feels like a verdict on their intelligence, their competence, their identity. This is why a trader will hold a losing gold position far longer than logic allows. Not because he believes in the trade anymore, but because closing it means admitting, in black and white, that his analysis failed. Confirmation bias steps in right on cue. Once a trader forms a belief that gold is heading to a certain level, his brain starts hunting for any scrap of evidence that supports that belief and quietly filters out everything that contradicts it. He will notice the 1 bullish headline and ignore 3 bearish ones. He will zoom into a 5-minute chart that shows a tiny bounce and ignore the 4-hour chart that shows a clear breakdown. This is not stupidity. This is neurology. The brain is wired to protect its existing beliefs because changing your mind, in evolutionary terms, once meant admitting you might have misjudged a threat, and misjudging threats got our ancestors killed. In a modern market, that same wiring simply gets your account killed instead. Mark Douglas spent much of his life studying exactly this gap between the logical mind and the emotional mind, And one of his central observations still holds true on every trading desk in the world today. The market does not need to prove you wrong. It simply moves. It is neutral. It has no opinion about your analysis. The pain of being wrong exists entirely inside the trader, not inside the chart. The professional solution to this fear is not confidence, ironically. It is humility built into the process itself. Professional traders do not ask, will this trade be right? They ask, is this trade worth the risk regardless of the outcome? That single shift from needing to be right to being willing to be wrong at a controlled cost is often the exact line between a trader who survives a decade and one who does not survive a single quarter. Now let's talk about the fear of losing money, which sounds identical to the fear of being wrong, but behaves completely differently in the brain. This is where prospect theory becomes essential, because prospect theory proved something that classical economics never accounted for. The pain of losing $1 is psychologically almost twice as intense as the pleasure of gaining that same dollar. This is loss aversion, and it explains one of the strangest patterns you will see in retail trading. Traders cut their winning trades short, terrified the profit might vanish, but let their losing trades run far longer than any rational plan would allow, because closing a loser makes the loss permanent, and the brain will do almost anything to avoid that finality. Picture a trader long on Bitcoin during a sharp pullback. The position is down 8%. Every rational signal says respect the stop loss. But the amygdala, the brain's alarm system, is now firing distress signals that overwhelm the prefrontal cortex, the part responsible for logical, long-term decision-making. In that moment, the trader is not thinking about probability or process. He is trying to avoid the emotional pain of confirming a loss, so he moves the stop loss further away, then further again, hoping the market will save him from the decision he does not want to make. This is precisely the emotional trap that swallowed so many traders during Black Monday in 1987, when the market fell over 20% in a single session. It was not only the speed of the crash that destroyed people, it was the paralysis. Many traders sat frozen, unable to execute the exit they knew, logically, they needed to make, because pulling the trigger meant making the loss real. The Jian, or two. Market gave them plenty of time to act. Fear took that time away. What separates professional risk management from retail? Hope is a mental reframe that sounds simple but takes years to truly internalize. A stop loss is not a failure. It is the cost of information. It is the price you pay to find out whether your idea was correct. In the same way, an entrance fee is the price you pay to find out what is inside a building. Once a trader stops treating losses as personal failures and starts treating them as a predictable, budgeted cost of doing business, the emotional charge around losing money drops dramatically, and decision-making becomes clean again. Now we arrive at a fear that has exploded in intensity in the era of 24-hour markets and instant price alerts, the fear of missing out. FOMO is not simply excitement. It is a dopamine-driven habit loop, and understanding that loop is the only way to break its grip. Dopamine is often misunderstood as the chemical of pleasure, but it is actually the chemical of anticipation. It spikes not when you receive a reward, but in the moments just before you might receive one. This is why watching Bitcoin rocket upward on a screen creates a much stronger physiological pull than actually holding a profitable position quietly overnight. The chart in motion, the green candles stacking, the comments flooding in about a coin about to explode. All of this triggers a surge of anticipatory dopamine that has almost nothing to do with sound analysis and everything to do with brain chemistry designed for a world that no longer exists. A trader watching from the sidelines sees price already up 30%, feels the pull, and jumps in near the top, not because his strategy told him to, but because the habit loop of cue, craving, response, and reward has already been triggered before his conscious mind even had a chance to evaluate the trade. The cue is the moving chart. The craving is the fear of being left behind. The response is an impulsive entry, and the reward, when it occasionally pays off, reinforces the entire cycle, making the next FOMO entry even harder to resist. This is precisely why professional trend followers like Seykota built systems that removed emotional timing from the equation entirely. Seykota's philosophy, distilled to its essence, argued that the elements of good trading are cutting losses, and cutting losses, because he understood that the moment emotion enters the entry decision, probability leaves the room. The antidote to FOMO is not willpower, because willpower is a limited resource that burns out under pressure. The antidote is a pre-committed plan, written and defined before the market ever moves, so that in the heat of a breakout, there is no decision left to make emotionally. The plan already made it hours or days earlier when the mind was calm. Finally, we come to the fourth fear, quieter than the others, but just as expensive, the fear of leaving money on the table. This is the fear that convinces a trader to hold a winning position well past his original target, not because new evidence justifies it, but because greed has quietly rebranded itself as conviction. Overconfidence bias plays a major role here. After a string of winning trades, the brain begins to overestimate its own skill and underestimate the role that variance played in those wins. Recency bias compounds the problem, convincing the trader that the recent trend of gains will simply continue because it has continued so far. This is part of what happened to countless traders leading into the 2008 financial crisis, when years of a rising, seemingly unstoppable market convinced both institutions and individuals that risk had somehow become smaller than it actually was. Confidence, built on a long, uninterrupted trend, quietly replaced caution, and by the time the market reversed, the very traders who felt most in control were often the most overexposed. On an individual level, this fear shows up in something painfully common. The trader who is up 300 pips on gold refuses to take partial profit because he is convinced it will run another 300, and watches the entire move reverse and erase the gain entirely. He was not wrong about the market. He was captured by the story his own mind told him about how much more he deserved. Stanley Druckenmiller, one of the most successful macro traders in history, has spoken often about the discipline of respecting the market's message rather than his own attachment to a position. Understanding that a market can validate you today and punish you tomorrow with no obligation to explain why. Ray Dalio built entire systems around this same humility, treating strong opinions as hypotheses to be tested rather than truth to be defended. Precisely because the fear of leaving money on the table is, at its core, the fear of admitting that enough is actually enough. Managing this fear requires a strange kind of discipline, the discipline of predefined satisfaction. Professional traders decide in advance at what point a win is a win, and they honor that decision even when their emotions whisper that more is available. This single habit, taking planned profit instead of chasing perfect profit, has protected more trading careers than almost any other rule in this industry. When you step back and look at all four fears together, being wrong, losing money, missing out, and leaving money on the table, a pattern becomes impossible to ignore. Every single one of them is rooted in the same biological conflict, the ancient, fast-reacting amygdala against the slower, more rational prefrontal cortex. The amygdala evolved to protect a body from physical danger in a fraction of a second, and it does not know how to distinguish between a genuine emergency and a red candle on a 15-minute chart. This is why traders with brilliant analytical minds still make emotional, self-sabotaging decisions under pressure. Intelligence does not disable the amygdala. Training does. And this is where neuroplasticity becomes one of the most hopeful concepts in all of trading psychology, because it proves that the brain is not fixed. Every time a trader consciously pauses instead of reacting, honors a stop loss instead of moving it, takes planned profit instead of chasing more, he is not just making a good trade. He is literally rewiring the neural pathway that governs his future reactions. Do this enough times, deliberately and consistently, and the response that once required painful willpower eventually becomes calm, automatic instinct. This is not a metaphor. It is measurable neurological change, built one disciplined decision at a time. Jesse Livermore, who understood markets with astonishing clarity nearly a century ago, wrote from painful experience that the game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, or the person of inferior emotional balance. He was not describing intelligence. He was describing emotional regulation, the ability to feel fear without being ruled by it. Tudor Jones built an entire career around defense before offense, famously stating that the most important thing for him was not making money but protecting what he already had, because he understood that survival, not brilliance, is what allows a trader to be present for the next opportunity. Richard Dennis proved something even more radical. He took a small group of complete beginners, people with no trading background at all, taught them a strict set of mechanical rules, and told them to follow those rules without exception, regardless of how they felt in the moment. Those beginners went on to generate extraordinary returns, not because they were gifted, but because they had no ego attached to being right. They simply executed. Dennis had demonstrated something that shook the industry, that the psychological framework around a decision often matters more than raw talent or market genius. All of these traders across different decades and different markets arrived at the same conclusion through different paths. The goal was never to eliminate fear completely, because fear, in its rawest form, is simply the body trying to protect you. The goal was to build a system, mental and mechanical, that allows a trader to feel fear and still execute the plan anyway, calmly, consistently, without negotiation. This is probability thinking in its truest sense. Understanding that any single trade is not a referendum on your worth, your intelligence, or your future, but simply one outcome in a long, statistically defined series. A professional does not need every single trade to work. He needs his edge to play out over enough trades that the fear of any one outcome becomes almost irrelevant. This mental shift from needing certainty to trusting probability is not natural. It has to be built slowly, deliberately, through repetition. The same way Black Monday taught an entire generation that markets can move faster than emotion can process. And the 2008 crisis taught another generation that confidence, without humility, is simply risk wearing a disguise. Successful traders do not eliminate fear. They train themselves to make decisions that are no longer controlled by it. That single sentence is the difference between a career and a cautionary tale. Fear will always show up. The amygdala will always fire. The only question that matters is whether, in that moment, you have built a mind strong enough and a plan clear enough to act anyway. Remember this. The market does not defeat traders. Traders defeat themselves, one fearful decision at a time, and the ones who last are simply the ones who learned to decide differently. In our next chapter, Trading in the Zone, Chapter 3, Thinking in Probabilities, we go one level deeper into the exact mental framework that lets professional traders treat every single trade not as a prediction to be right about, but as one data point in a game they are mathematically destined to win over time, and why learning to think this way may be the single most profitable shift you ever make in your entire trading career.